Good afternoon, everybody, and welcome to the Meaning of Life, Tax and the Digital Universe, an Asia-Pacific perspective. Unless you've had your head in the sand for the last 5 or 10 years, you will have heard of digital currencies, Bitcoin, cryptocurrencies, whatever you like to call them. And you'll probably have realized that despite all the trials and tribulations that they seem to have been through during that relatively short lifespan, things like scams, hacking, bandwagon jumping, valuation fluctuations, etc., association with drugs, money laundering, and the like, you will see that they are still going from strength to strength. And in my view, and I'm sure the view of the people we have with us today, they're going to continue to go from strength to strength. So you can try to ignore them, but that is going to get you nowhere in the long run. So what we're going to look at today is the taxation of these new kids on the block, looking at whether the current tax systems in various countries are fit for purpose, whether they can cope with the changes that are happening almost on a daily basis, whether the tax authorities are keeping up to date with this, or whether in fact, in some cases, they might be ahead of the game or ahead of the curve. We'll be talking to a panel of experts from 3 countries around the region, India, Hong Kong, and Australia, and we'll be hearing their views on where we're heading, where the tax authorities and tax legislation and tax thinking is heading around the digital universe. And so before we kick off, just a bit of housekeeping, the inevitable questions. Yes, there's going to be a Q&A at the end of the session, but what we thought was we'd be a bit innovative this time, and we've given you a little opportunity to vote about questions that you see. And the purpose behind that is that if you see a question that you like, or maybe that you would have liked to have asked yourself, give it the thumbs up, and that means that we can then get an ordered schedule of what are the most popular questions and the ones we should be answering first, to make sure that we can get as much audience interest as possible. If you look in your chat box, other things that are going on in and around this will be given. And then, yes, the inevitable Q&A first question, a recording will be made available of this at the end. So what are we looking at today? Well, I thought it made sense to start off looking at the Singapore context, not just because we're running the seminar, but really as a backdrop to some of the discussions we're going to have when we come to talk on the panel session later on, because you will see that there are certain core principles around taxation that will apply universally, or we would think should apply universally. And bearing in mind that the members on the panel this year are from Commonwealth countries, which were all ultimately born out of the UK tax system originally, there should be a number of similarities that we can compare and contrast. But we're also going to be looking at the accounting treatment, because accounting, although persuasive and not determinative, is increasingly swaying the minds of tax authorities. And we'll take a look at that later on. I brought along our head of financial reporting advisory services, Chetan Hans, who I take everywhere. Whenever I go to meet a client, I bring Chetan with me, and wherever he goes to meet a client in this area, he brings me along, because the accounting and tax go hand in hand. Following the Singapore context, we're then going to have open discussion around, I think, what are the hot topics that people are talking about, what we find clients are coming into our offices and asking questions around, and what we're being asked to give advice on. And then at the end, an opportunity for questions and answers. Some of the things we may not be able to answer within the members of the panel, but we've dotted a few cunning experts around the audience who may be able to chip in and give some further context to those questions. So let me just quickly put this in context. What's it about? And what are cryptocurrencies, or the cryptocurrencies that we're talking about? Essentially, there's three types of digital assets. There is the payment token, the utility token, and the security token. And the easy way to conceptualize these things is to think about things that are familiar to you. So if you think of a payment token, think Bitcoin. There's nothing else you can do with it apart from sit on it or spend it. It doesn't produce in its own right any income, and it's like cash. A utility token is a voucher essentially that can be exchanged for goods and services somewhere further down the line. So think about going into Takashimaya, and instead of actually choosing a Christmas present, you buy a token, give it to someone for Christmas, and then they can come in and help themselves to the goods and services later on. And then a security token, which is quite simply what we would think of as debt or equity in a company or a business. And then, of course, we have the inevitable hybrids of all of this, things that aren't quite one or the other, in which case you need to take a step back and think a bit more closely about what features these tokens actually exhibit. The point, though, is that these are assets, and these are just like any other assets, and they can be invested, traded, exchanged, and whatever else you can think of to do with an asset. So in that respect, there is nothing new. And what can you do with digital assets? Well, here's just some of the things that I could think of. You can mine it when you dig it out at the beginning, just like any other commodity. You can ICO it, initial coin offer it, when you issue it as a utility token. That used to be done, or still is done, outside of regulation. But of course, such tokens sometimes ran a bit close to the wind and tipped over into the regulatory side when they were effectively security tokens, i.e. giving some rights or obligations over another asset. You can invest these things, you can sit on them, wait for them to grow in value, or last few weeks go down in value. You can lend them out and get returns. You can trade with them. You can use them to pay for goods and services. You can reward your employees, which is something we're seeing increasingly happen in and around the industry. And you can send it to your loved ones for Christmas, which is quite a nice thought, actually, a Bitcoin in your Christmas stocking. And then some peculiarities that seem to apply only to in the digital asset arena. You can stake it, airdrop it, and fork it, but we'll probably be staying away from that. So what I mentioned, accounting goes hand in hand with tax. You can't do one without the other or by ignoring the other. So what we've got here is Chetan, who's going to do a little intro into financial reporting around cryptocurrencies. So Chetan.
Thanks, David. Right. So, we will cover, the broad principles on how to account for it, and I'll probably follow a similar theme as David, focusing on the 4 types of cryptos. And then the discussion is primarily centered on IFRS. So, if your jurisdiction doesn't have IFRS equivalent standards, then there might be different rules that may be applicable to you. So moving on. So as I said, we're focusing on IFRS. So in Singapore, we follow SFRS, which is aligned to IFRS. Similarly, other countries like Hong Kong, Australia, India also have IFRS equivalent standards. Now, under IFRS, there is no specific guidance. Which prescribes how to account for it. While there has been certain interpretations given by the IFRS Interpretation Committee, and that's the sole source of accounting literature at the moment. So we need to understand the nature of the crypto assets that we are holding, and then apply those those interpretations. So as of now, there's no accounting standards which deals with digital assets. There's just an interpretation which we need to apply. And on the next slide, I'll take you through what the key standards that we need to consider. So as part of the interpretation, the accounting, the ISB or the IFRS Interpretation Committee, they assessed what all standards can be considered for holdings of crypto assets. So the first one was statement of cash flows to determine whether it can be categorized as cash and cash equivalent. And the decision was that it cannot be classified as cash and cash equivalent primarily because there is a very high risk of change in value. So the way IFRS currently defines cash and cash equivalent is that there should be an insignificant risk of change in value, which is not the case with crypto assets or digital assets or NFTs or any form of digital assets. So it cannot be classified as cash and cash equivalents in your financial statements. Now, coming to other financial instruments, whether we can classify this as financial instruments, then again, the idea was that an instrument is considered a financial instrument only if it arises by a contract, and B, it is exchanged. It is, if it's an asset, it gives you return in form of another financial asset or cash equivalent. Given the fact that most of the cryptos do not have a fixed return in the sense that, you cannot redeem it, you can only trade it. And again, whatever you get, it doesn't meet the definition of cash and cash equivalent. So most of the crypto holdings will not be a financial instrument. However, stable coins like USDC and USDT meet the definition of financial instruments. So when you're accounting for different crypto assets, you really need to look at what the characteristics are. So broadly speaking, the security tokens are likely to be financial instruments, whereas your payment tokens and utility tokens probably will not meet the criteria for financial instruments. For the hybrid tokens, as David mentioned, you probably need to really understand what the underlying commercial substance is to determine whether you need to account it as a financial instrument or anything else. Then investment property was also considered by the standard setting by the board, but again, it did not meet the definition for either investment property and property, plant and equipment, primarily because crypto assets do not have a physical form, and these standards deal with physical assets. So this then leaves us with two residual categories. One is intangible assets, and the other one is inventories. Now, how do you determine whether it's an intangible asset or an inventory is again based on the business model that the company has. What's your purpose of holding the asset and how you intend to use the asset. So I'll move on to the next slide. So if the purpose of holding the asset is trading, wherein you're making quick trades, you're doing all sort of trading activities, buying, selling, staking, DeFi, whatever, but the idea is to generate return through movement in prices of the asset, then you will fall under the inventory standard. Within the inventory standard, if you are doing trading, you may be classified as a dealer broker. And if you're get classified as a broker dealer, then you have to record these inventories at fair value through profit and loss, which essentially means that every reporting period, you will mark to market the value of your digital assets, and any gain or loss goes through your P&L. Now, the second business model could be that you are not trading, but you're actually dealing, right? You may be minting cryptos, Bitcoins, and then you're selling it in the market. You may be minting NFTs and you might be selling it in the market. In those scenarios, you cannot apply the fair value model because you're not a broker dealer. So then in those scenarios, you will have to record it at lower of cost or NRV. So any upside in the value of the crypto assets will not get captured in the books, but any decline in the value will be captured, because at every reporting date, the standard requires you to record inventories at lower of cost or NRV. And the third purpose could be that, you're just holding the asset. So even while you have minted, you're not selling it, you're just using it to make payments to your employees, you're holding it to generate returns from capital appreciation. So then it becomes an intangible asset for you. Now, within the intangible assets standards, you have two accounting choices. One is what we call as a revaluation model, and the other is a cost model. As the name suggests, under the revaluation model, you will mark to market the crypto assets, and any mark-to-market gains will go through the other comprehensive income. So these gains do not pass through your P&L. Instead, it passes through other comprehensive income, and are then classified in the balance sheet as a revaluation reserve. You will continue to, in case of cryptos, we will generally not have an amortization because these are considered to be an indefinite life asset. So you will carry them at fair value, and if there's an impairment, that impairment will have to be recorded, which means if there's you initially recorded an asset at 100, from 100 it went to 150, but then it came down to 90, then first we will utilize all the revaluation reserve, and the additional $10 loss will be recorded in P&L. So any impairment in the value below the original cost always goes through the P&L. The second model is the cost model. So again, in the cost model, you do not change the value. You record the asset at the value at which it was on day one. And thereafter, you do not recognize any mark-to-market gains and losses. No amortization because it's an indefinite life asset. But yes, you have to test it for annual impairment. Because there was no revaluation upside, any decline in values, again, would be through P&L. So what we have now so far discussed is what happens if you hold the asset, when you're holding a digital asset. But then the other side of the transaction is what happens when you issue a crypto asset. So here we need to consider whether the token meets the definition of a financial liability. So again, you would need to consider whether there's an obligation. So like financial asset, which is driven by a contract and where you have a right to receive contractual cash flows. In a financial liability, you have a contractual obligation to pay cash or settle through any other means. Now, if you are settling something, you have an contractual obligation to settle in cash or cash equivalents or any other financial asset, then it will be a financial liability under the accounting standards. So again, considering the example of USDC and USDT, the issuers will probably have to show it as a liability. Then the next question is that if I don't have an option to repay, then does it meet the definition of equity? This is where it gets really tricky, because a lot of time the token gives you a lot of governance rights when it comes to the platform or the protocol, but you don't have rights related to the entity itself. So you really need to understand what are the rights that I get by subscribing to the token, whether it is the entity level or whether it is the platform or the blockchain level rights, and then determine whether it meets the definition of equity or not. In our experience, most of these governance rights generally do not meet the definition of equity under the accounting standards, because you do not have governance level rights at the entity level. So the next standard to consider is IFRS 15, where you consider these tokens as a prepayment for goods and services. So as David explained the concept of a utility token, these are essentially like vouchers. You pay something today to get a token, but you get benefits in the future. It could be discounted services, or it could be access to certain services which are not available without this membership. So in this case, you have to apply an appropriate deferral model, because the issuer has taken consideration today, but has a promise to deliver certain services in the future. So the company will have to determine what portion of the money collected can be recognized as revenue today, and what is the future performance obligations, and then accordingly do a bifurcation between different accounting periods. And last, but I'm sure definitely not the least, considering how the use case of cryptos is evolving, is being used as an incentive for rewarding employees. So when it's used as a token incentive or a token option or any combination of these two, then we need to apply IFRS 2, which is a share-based payments. So the principles will be similar. So we need to take into account the value of the token at the date it was granted, and also consider vesting conditions, and essentially amortize that value over the vesting period in the P&L as a payroll cost or as a salary and wages cost. So that's the summary of accounting. So I think this area continues to evolve, but that's probably what we have currently on the accounting side based on the IFRIC consideration. So with this, maybe I'll pass it back to David to add more color from a tax perspective.
Thank you, Chetan. So a potted history of where we are with accounting. So let's take a gallop through tax. This is tax from 10,000 feet. Although someone seems to be controlling my screen, but I'm now controlling it. A gallop through a couple of things. First of all, in terms of Singapore, have we had any IRAS pronouncements? Have we had any tax legislative changes, et cetera, et cetera? And then we're going to look at income tax, which, as I mentioned, goes hand in glove with the accounting treatment. We'll see the influence of that. And then we'll take a look at the taxation of specific types of transactions and the situations you can find yourself in when you're dealing with cryptos. We're then going to have a quick look at GST classification and how they deal with it in Singapore. So the pronouncements so far from the IRAS have been relatively thin on the ground, and you'll see that the first one was actually a GST circular that came out in November 2019. That sort of set the scene for how a GST was going to approach things. I think there was a bit of a U-turn from what the IRAS had originally thought, or how they originally thought this was going to pan out for GST. That now has been tidied up, and it's been actually put into legislation with effect from 1 January 2020. We're not going to look at that. It's just to give you a peg as to where we are in the developments here. The e-tax guide on income tax treatment of digital tokens came out a few months later in April 2020. And what we have to say is that there were no real surprises in there. And we were pleased to say there were no real surprises. That doesn't mean to say, though, that the system that we currently have is fit for purpose and fit for all the changes that we see taking place in the technology world. But just to compare and contrast between the GST approach and the income tax approach, income tax splits the types of token into those three that we looked at earlier: payment token, utility token, and security token. And the pronouncements, the e-tax guide gives some color around what each of those means. GST, on the other hand, is binary in that there is a payment token, and that is quite closely defined, and then everything else gets treated in the same way. So we'll take a look at what that means in a second. So first of all, income tax. The IRS circulars came out with nothing new, nothing surprising, and there's nothing in the law that specifically caters for transactions in digital tokens and the like. So it's back to basics. And what are the basics? Well, as with any tax question, you need to ask these four. First of all, is my profit or my loss capital or revenue in nature? What is the source of that profit? Where does it come from? When is it taxable, if it is taxable? And then what is the value that is applied for tax purposes at that particular time? Without giving too much away, those are really the only questions you need to ask in tax anyway, and they're exactly the same questions that you need to ask when you're approaching a digital token. I mentioned, obviously, the influence of accounting treatment on tax, and just to sort of summarize where it is big picture, it goes into intangible property if it's an investment, inventory if it's being used for trading, and financial instruments if it actually falls into that category or can be categorized as such. The accounting treatment has always been persuasive for the simple reason that when you do a tax computation, you start with the accounting profit. So you're already quite a high percentage of the way there. However, tax has its own rules, and the accounting treatment is not determinative if you can find reasons why the accounting treatment contradicts basic tax principles. For example, in Singapore, we have specific legislation which directs you to use the accounting treatment rather than what has traditionally been the tax treatment. And if you look at what tax treatment is all about, it is again this capital versus revenue question. Well, capital isn't taxed in Singapore, and as William will tell you later on, it isn't taxed in Hong Kong either. So that's a very important thing to be able to know. So if you start peppering your accounts with things that have a revenue type feel or direction about them, then that can be very unhelpful in your arguments that these transactions are on capital account. Also, the timing of recognition, one of the cardinal principles of taxation is that it's not due, taxation cannot be imposed until the profit has come home and been realized. Well, a lot of the way that accounting standards are moving is towards substance over form, mark to market rather than realization. So you have to be careful in what direction the accounting treatment is pointing you, and in particular, if you've got specific legislation that tells you you follow the accounting treatment, then clearly you have no choice. So the first piece, income versus capital. Singapore and Hong Kong don't have CGT regimes. India and Australia too, and hopefully we'll hear later on whether the distinction here is as marked as it is in Singapore. Generally though, I would imagine in all of the countries we're looking at, the badges of trade will be used to detect the real nature of transactions, i.e. whether there is a trade being conducted, because if we are conducting a trade in these assets, then transactions as far as Singapore is concerned, if that trade is carried on in Singapore, is that they will be taxed as ordinary income. Helpful tip, and this goes back to the way that accounting can influence things. Don't account for capital assets as inventory. Get those things sorted out before ink hits paper, so that you're not fighting with one arm behind your back in a capital versus revenue argument. Some questions. Once I've earned my income, once I've taxed the transactions and the residue, the profit goes into my wallet, how is it treated when it sits in there? Well, maybe we'll get some color around that when we do the panel session later on. As we also discussed, hybrid qualities, as with the accounting, you have to look more closely at the substance behind the instrument to determine how it is going to be taxed. The thing I'm finding with Singapore, though, is that there seems to be this general misconception about Singapore's tax friendliness, because we're getting mixed messages from all over the place. I was talking to a reporter a few weeks back, and he said, oh, well, of course, cryptos don't get taxed in Singapore, do they? I'm going to write an article about it. And I said, well, you're not going to write an article about cryptos not getting taxed in Singapore, because if you happen to be trading in cryptos, or, you know, even selling them, dealing in them on a regular basis that tips the scale of frequency, then you can be regarded as trading, and they are treated, the gains that you make are treated as normal taxable income. So it's untrue to say that Singapore has any sort of tax freeness about it. On the other hand, people think it's all doom and gloom. And then, of course, on the regulatory side, we see this sort of stuff. Singapore will crack down on bad crypto behavior. The MAS will be brutal and unrelentingly hard. So a lot of these things are how you write the headlines. When you look at the detail, of course, all they're saying is, we don't want any cowboys in town. We want to do this properly, and we are supporting it. And another rather funny one I came across the other day, many tax havens like Malta, Singapore, and the Cayman Islands have embraced blockchains, making it easier for crypto natives. So on the back of all this stuff, it's hardly surprising that there's still quite a deal of controversy and confusion going around Singapore. Source of income is probably more critical, though, for Hong Kong and Singapore, for the simple reason that they have territorial basis of taxation, whereas India and Australia tax on a global basis. So for Hong Kong, that means if the source of the income or profit is outside of Hong Kong, it doesn't get taxed. If the source is outside for Singapore, it doesn't get taxed until that income is brought in by a non-individual into Singapore. And there's a whole host of things that you need to look at in order to determine what the source of the income is. And just because you set up a company in Singapore and start contracting through it doesn't naturally mean that the source is Singapore, and vice versa. That gives some issues for our friends, the digital nomads, who are out there in Asia, probably by chance coming across a stash of coins that they want to do something with, or a software platform that they want to build around the blockchain, etc., etc. They often ask the question, oh, well, we'll just set up a company in Singapore and we'll issue the token through Singapore, and there you go. No, it's absolutely not as simple as that, and we'll hopefully be discussing that later on in the panel session. And the question is, what if people are distributed like the ledger that all this is based on? You've got authorizations around the universe authorizing and confirming transactions in a distributed manner, but also the people that are running these businesses are all over the place. And that is one of the areas where I see tax systems not quite fit for purpose as we look into the future. And timing of recognition. The basic rule, taxable when it's realized. Well, that means you don't need to do anything more to earn it. Just wait for the money to come in. You know how much it is, and you won't have to give it back. It's all yours. That principle, basic principle of taxation, is often at odds with accounting principles, which, as I mentioned, increasingly allow you to anticipate or indeed defer income. And the case in point around there is FRS 115 or IFRS 15, revenue from contracts with customers. And we'll see how that affects the universe in a minute. And then the valuation of transactions. I won't dwell on this one too much, but essentially what we are directed to do is that once you have determined the point at which taxation is due, you then need to value it. Now, the question is, if I'm exchanging pigs for goats, do I look at the market value of pigs or do I look at the market value of goats in order to determine that value? Fortunately, we have a number of exchanges which sort that issue out for you, and you can look up the swap value of the various currencies for a particular date and time. But if they're off exchange transactions, then not necessarily so easy. And then just a quick run through of how the principles apply. Based on the circular issued by IRAS, it's necessary to characterize the tokens in order to determine their treatment. True, but ultimately it's a question of what you're using those tokens for, because you'll see that each of them, even though they individually exhibit different features and entitle you to different things or nothing in the case of Bitcoin, you can still exchange them, trade them, lend them, buy them, hold them, etc., etc. So the question is, what are you doing with these assets in order to turn them to account and to make money for you? So you can get too caught up in this characterization of what the tokens were meant for and what they're actually being used for. And so, as always, we're back to where we started, at the foot of the tree. When you're looking at income tax principles, ask yourself, is the transaction capital or revenue? That can be affected by the accounting treatment. What is the source? Is it inside my country or outside my country? And does it make a difference? When do I get taxed? Is it realization or is it on a mark-to-market basis? And then how do I find the value at that time? Oops. And then just before we finish on this, you'll remember Chetan talked about the issuer of tokens. And of course, what's happening here is that you are giving somebody tokens and you are receiving something in return. And the question is that something that I receive in return income, or is it an investment? Well, I think in the case of security tokens, it's probably quite clear that you are being given this money, but at some point you will have an obligation to return it to the person that is giving it to you. So it could be in the form like equity, it could be like debt. And so that's not income. However, with payment tokens, the proceeds, that's it. You just issue the tokens and everyone walks away. You walk away with the cash, they walk away with the tokens, game over. And so that is probably going to be taxable. Utility tokens are a bit more complex because they may depend upon what is on offer. However, again, Chetan alluded to it under IFRS or IFRS 15, which is that if the money coming in from the issue of a utility token is income, because I never have to give it back, then when do I account for it? Now, if there's a very clear project with milestones, and then there's an end game and specific goods and services that you can exchange it for, then that could be regarded as a prepayment, and therefore can be treated on a deferred basis under IFRS 15. However, if you read some of the white papers, certainly some of the earlier white papers, there were actually no contractual obligations for an issuer of utility tokens to produce anything at all. And so that must really raise questions as to whether the income coming in from the issue is income and taxable immediately. And the issue with that is that if you have income coming in year 1, but you only spend the money in year 2, 3, and 4, there is no mechanism under the current law to relate those expenses back and set them off against the income. So you get taxed up front with no recognition of the tax of the costs that are incurred later on. I think that is one that is still out there and hasn't been looked at. And as I say, security tokens, think of them as debt or equity. And if you can't work out whether they're debt or equity, look at the guidance given by IRAS on hybrid instruments. So the conclusions on income tax: look at the basics, answer those 4 questions, and you have got the answer, although getting those answers aren't always that easy. And don't forget the influence of accounting treatment. Make sure that you're not painting yourself into a corner by presenting the transactions or presenting the assets in the wrong light in your financial statements. So that was income tax. And as you saw earlier, as a refresher, GST recognizes only 2 types of token. That is digital payment tokens, which are quite closely defined, and the rest. And what does that mean? It means that where a digital payment token is used as a form of payment for goods and services, then it's treated as if it's cash. It's not a supply of anything. Handing over that digital payment is just like handing over cash. If, on the other hand, you are exchanging digital payment tokens, think of it as if you were entering into a Forex transaction. So you swap Sing dollars for US dollars and then swap them back, and you make a profit. That transaction would be regarded as an exempt supply, and the value of that exempt supply is essentially the difference. It's not the gross value of the transactions that make it up. It's the absolute difference between the two. It's the profit or the loss you made. If it's a loss, you take away the negative sign, essentially. Interest derived from loans of digital payment tokens, as with any interest, if you're lending to a local entity, then the interest is exempt. If you're lending to someone outside of Singapore, then it would be 0 rated. And then all other tokens are treated as a supply of services, which means it's a 2-way supply. I'm swapping pigs for goats, and each of them would be subject to GST in both directions. And the value reported, again, has got to be based on the open market value. What does that mean? What's the price of a pig? What's the price of a goat? Look it up if you can. If not, get out your calculator and see what you can do. So that was a real whip through the income tax and GST issues that we see in Singapore. But as I mentioned, hopefully they give a sort of anchor point for our discussion going forward and some commonality between the jurisdictions that we're talking about. The issues that I think are still out there, ICO proceeds, are they taxable and when? Treatment of unspent tokens, once you've done your deal and you put them in your wallet, what are they? The source of income in a distributed business model, when you've got people all over the place, how do you determine the source of income that is coming in? Rewards for employees and service providers, which we're seeing quite commonly. People are getting digital tokens rather than shares because they're not shareholders. DeFi spelt that incorrectly. DeFi transactions, essentially lending out, making funds, cryptos available for others who pay you for the pleasure. And then the question of incentives. Singapore has a very thriving and mature tax incentive regime for funds, but for the time being, cryptos are excluded from that elite club. Perhaps one day we will see that changing, but these are just some of the issues that are out there. So on that note, we're going to turn to the panel session, and I will invite our three other panelists to join us. And very kindly coming along, and particularly for Tim Hands from Australia, who we learned today is suffering from COVID-19, which is why we've kept him in Australia and didn't fly him over for the day. Tim is a tax partner with Grant Thornton Australia, who regularly works on these sorts of assignments. William Chan from Hong Kong, similarly, we're going to get his views around what's happening in Hong Kong on the crypto scene. And Richa Soni from GT India, who will be giving her take on what seems to be some very sort of fast and footloose developments in India. So maybe, Richa, we can sort of start with you, and you can help us out on what's going on in India, because it strikes me that the Indian tax authorities are sort of taking the lead on some of these issues.
Yeah, thanks, David. So yes, there are some new developments in India, and this is that a new taxation regime has been put in place for what is being termed as a virtual digital asset. Now, this regime is just about 3 months old. It became effective from 1st April 2022. So yes, we have to see how it evolves. But very broadly, what it says is that tax has to be paid on income from transfer of a virtual digital asset. Now, this is to be paid at a rate of 30%. As far as timing goes, this will obviously be the year of transfer. And this is completely agnostic of the fact whether you're holding it as an investment, are you trading in it? So whatever be the nature of your holding, the tax on transfer is going to be 30%. Now,
wow.
There is...
Sorry, that chucks my capital versus revenue comment out the window.
Yes, indeed.
Makes life easier, though.
Yeah, it does. Now, another interesting point is there is no deduction for anything else except the cost of acquisition. If you have a loss, it's a dead loss. So you cannot set it off against any income. You cannot carry it forward. Also, a gift of a virtual digital asset is taxed in the hands of the recipient. In certain cases, there are exceptions, but in most cases, the fair market value will be taxed in the hands of the recipient. And the valuation guidelines for this one are yet to be rolled out. So we have to see what exactly the valuation turns out to be. But this is broadly how the new regime in taxation looked like. So prior to this, of course, the regime was there where you actually looked at the general principles which you talked about. So the capital versus revenue and all. So that comes to an end with this regime coming into place.
And what do you see as the motivation behind that? It sounds like they're trying to keep the thing away, because there was an attempt at banning cryptos, I understand, in India. Is this sort of banning Mark II through the back door?
This is actually taxing it like a windfall gain. The way the windfall gains are being taxed in India. As far as banning is concerned, there was news that there is a regulation bill which is going to be placed in the parliament in December 2021, which did not happen. The current news is that there is a new paper, a consultation paper, which is being developed. And here, they've taken inputs from various stakeholders. It includes the IMF, the World Bank. So they are going slow. There's a lot of deliberation. It is possible that in next couple of months, this consultation paper on the regulatory regime is rolled out. There have again been news of the central bank, which is the Reserve Bank of India, issuing a virtual currency. Here again, they are analyzing it. They are going slow, taking into account various inputs. A graded approach is likely to be followed. Also, the finance minister has been speaking about a framework which is uniform across all the countries in the globe. So she's been propagating that you should have something which is where the regulatory and the tax regime is similar. So we don't really foresee a complete banning. But while this regulatory regime is being worked on and thought is being given, perhaps it was felt that at this point of time, since we hear that it is about 105 million Indians who've already invested and the valuation to say about 5.4 billion. So might as well mop up whatever tax revenues can be generated.
Might as well make something out of it while it's going. Wow, that sounds very interesting. But are you finding that clients are therefore keeping away, or they're still very avidly interested, but they just want to know, are there any ways around it?
Well, there is definitely interest. Why? One reason is, there are certain aspects to it. For example, the definition of virtual digital asset. It is very broad. It says it could be any information, number, code, or token, which is generated through cryptographic means or otherwise. Anything which can be stored, transferred, or traded. So it includes a whole variety of things. It could be even your travel miles, the airline travel miles, what a marketplace issues you in case of coupons. It could be even your credit card points. So a whole lot of things come in. So there is a lot of interest to understand that what other aspects can get covered. So it seems that the government is likely to come up with some clarification or some sort of a negative list to keep out certain elements. So far, there is no distinction between a utility or a security token. Everything gets classified as a virtual digital asset, but quite possible some of these might come in. So the interest is there, a varied interest, understanding the new regime, how it is going to impact the businesses. There was a dip in volumes because obviously, there's a cautious approach being followed, but nothing too material.
Right. Okay. So maybe we should go to Australia to see if unusually it's less draconian there, because the ATO don't have the best reputation for being easy on tax, do they?
Oh, look, it's a good point, David. And unlike India, which seems to be jumping ahead in leaps and bounds in terms of passing new legislation to deal with these kinds of assets, Australia is falling a little bit behind. So a bit of a history here. Australia was actually ahead of Singapore when it came to GST treatment for digital assets. They introduced a new definition to the GST Act back in 2017, which defined digital currencies, very similarly to payment tokens, as you have, David. However, that is it. And so the ATO is effectively interpreting old legislation for new world digital currencies and very much not giving any guidance whatsoever.
Right.
There was a ruling given back in 2014 in relation to Bitcoin, And unhelpfully in that ruling, the ATO said that Bitcoin is not a foreign currency because there is no other country in the world that has adopted Bitcoin as its national currency. And of course, that all changed recently when El Salvador adopted Bitcoin.
Yes,
So,
perfect.
So the ATO has recently come out, or actually, it was Treasury has recently come out and said, no, we'll be updating that to make sure that Bitcoin is not considered a foreign currency.
So every country other than El Salvador.
Correct. So that's sort of where we're at in Australia. It's very much been a softly approach. The messaging coming out of the ATO up until recently was make sure that you declare all of your digital currency or digital asset transactions in your tax return under self-assessment. The messaging coming out in the last month is, we'll be very watchful of anyone that's seeking to claim a business of trading in Bitcoin, because in Australia you can offset your losses from business against other income.
Right.
And given what's happened lately with the markets,
But no one will be paying this year. Yeah.
there will be a lot of focus on those taxpayers seeking to offset digital losses.
Yeah, that's interesting, because I mean, obviously you've got capital gains tax and in Australia, which means that there is a sort of reporting obligation anyway. In Singapore, it's slightly different because you've got income and you've got capital, and capital doesn't get reported. And so it's presumably Australia has all the mechanisms that enable the collection of capital gains tax. So even if you're not trading, you're still going to be caught for CGT.
Yeah, correct. So we have a full self-assessment system here in Australia. Distinction between capital and revenue, as you know, David, is there. For assets held for longer than 12 months, we give taxpayers a 50% discount on capital treatment, but not on revenue treatment. So if you've managed to hold your Bitcoin for long enough and you've disposed of it, arguably you can get a 50% discount if held in your own name for the tax on the disposal of Bitcoin.
Right. Okay. Well, that's quite helpful, because again, in Singapore we don't have any bright lines like that, which I think is something that that could be missing. But in general, do you feel that the ATO are savvy about this, or are they all at 6s and 7s? They don't know what they're doing?
I would say they're very savvy about the potential to raise revenue from these new assets. They are struggling a little bit in terms of having to apply existing tax concepts to digital assets. And indeed, some cases, we've got ruling requests that have been on foot for somewhere between 12 and 18 months, where they just cannot make a decision around how they should be treated. So the prevailing view and the prevailing messaging is treat them reasonably, which is all the guidance we're getting.
Okay, well, we could probably sit and talk about this all day, I'm sure. So, William, talk us through Hong Kong. What's going on there?
Hong Kong fairly similar to Singapore, like you have alluded to it. I mean, we don't tax capital. I mean, a few years ago, there was a lot of ICO in Hong Kong because, I mean, good old days, all the ICO are really security fundraising stuff. But like lately, we have seen some, well, not lately, but after that rush, then a lot of like some of them actually are security, not security, they are actually service. You are obliged to provide some sort of goods or services, and that will become taxable. If it's fundraising, they're not taxable at all because like you buy security, and there's a lot of clever tricks in it. And you raise the fund, but where you're investing, right? So they have this fintech. A lot of people use the money to claim that they invest in fintech, but what's fintech? So and then it becomes going back to invest in crypto. So again, I think there's a lot. Might have a lot of cases in future, in coming years, that the IRD will be in an effort to go attack those people that are treated as capital before, but then you end up as investing in cryptos at the end. Because crypto making a lot of money for the last 2 years. Dollar, I mean, recently they've been losing a lot of money. But if you go back for the accounting year, 2020, 2021, they could be fairly profitable.
Yeah, no, indeed. But just looking at what we were saying about Singapore, where would you put Hong Kong? Ahead, behind, same?
I think we are lagging behind. If from legislation point of view, I mean, we only just issued the departmental practice note in revising practice note in 2020, talking about digital economy, digital asset, and e-commerce. And they hardly anything on digital asset because we're still not treating it as an asset class, a separate asset class. For now, we just go back to the basic, like you say, it's either capital or revenue. So you have to make sure you book it correctly, the account, because fundamentally they go to the accounts treatment first. If you book it as for sale asset, then you're done. They have to If you already from day one, you have to make up your mind, say, I'm not going to dispose of it in the next 12 months, then completion or auditor, this is not a for sale asset. Then you hold it for a number of years. Sadly, again, we don't like Australia. We don't have a guideline. We don't have a period like 12 months afterward. It's capital, or at least gears towards a trend towards capital. In Hong Kong, same as Singapore, we don't have like 3 years, 5 years, 10 years.
Yeah,
we don't know.
Look
at measures of trade, what your intentions are, how often you do it, kind of thing. So, as a rule of thumb, if you hold it for more than 3 years, you get a good chance to argue as a capital plus the accounting treatment.
Oh, okay. So Hong Kong, in that respect, seems to have some brighter lines around it. And of course, you have the benefit that if any of this is sourced outside of Hong Kong, not taxable at all.
Yeah, we are source basis. So I mean, since Singapore, we have the fund regime that got tax exemption for what we call unified fund exemption regime, but it doesn't apply specifically. Say it doesn't apply to any crypto trading, crypto asset, digital asset. So you have to make sure that if you're doing fund investing digital asset, you got to make sure that nothing happened in Hong Kong. Right. So go to the good old days, the fund regime, no exemption. Fund regime in Hong Kong, so you have to make sure your fund, the Cayman funds, actually operate outside Hong Kong, except with an investment advisor in Hong Kong. You advise on strategies, and then you make your own decision outside Hong Kong. Then there's a good chance that it is not sourced in Hong Kong.
Yeah, which means you have a slight advantage still over Singapore in that. I detect that in Hong Kong, you only need to prove that it's not sourced in Hong Kong, but don't necessarily need to prove where it actually might be sourced. Whereas in Singapore, if you say not sourced in Singapore, they say, well, where is it sourced? And if you can't prove it, it'll default back to Singapore.
Actually, interesting that point, because the Inland Revenue have just recently lost 2 cases about source of profits rules. They attack people that, if you have done so many things in Hong Kong, will be sourced in Hong Kong. And then they lost 2 cases. At least one big case they lost. The guy actually done quite big things in Hong Kong, but then they claim that they proved that most of the decisions are made outside Hong Kong. So then even though these banking facilities in Hong Kong, a few of the people working in Hong Kong do logistic kind of things, surprisingly, NRF lost pretty badly on their case. So yes, and again, you don't need to prove that you have paid tax elsewhere.
Yeah.
And so then it's slightly better than we are 1 number 2 than index score.
And it's being made easier for tax authorities because of exchange of information articles. They can just get on the phone to each other and find out exactly what's going on. So
might because you guys are more tricky than us, you get more sources of places you can call. In Hong Kong, we were 60 odd trickies. So only a limited friends you can call.
Yeah, okay. So I mean, just touching on source there, I think it's an interesting question that maybe is quite particular to the crypto world. which is you don't know who you're dealing with. Who is at the other end of the transaction? You know, because it's just it's an address, although it can be traced. Wallets are in, you know, my wallet is in my drawer, or it could be in the cloud, or it could be somewhere. You know, how do we identify who the counterparties are? Richard, is there any issues around that in India? Because it started as a sort of GST issue, because you're going, well, should I zero rate this? Should I exempt it? I don't know, because I don't know who my counterparty is.
Yeah, so I'll take up the taxation, the income tax first. So here, you know, there is under the new regime a withholding tax requirement which has been put in. So anybody making payment is required to withhold 1% of the gross receipts. And so there was a lot of confusion as to, you know, in various contracts, how do you figure out the counterparty? So just recently a circular has come in where they have tried to give certain situations which kind of trying to plug in whatever to the best extent is possible. So wherever the party is known, the payer is required to do a withholding. Wherever an exchange is involved, so the exchange has been given this responsibility of doing the tax withholding. There are scenarios where this exchange owns or is dealing through a broker. So again, specific responsibilities have been put in. Exchanges have also been given a reporting responsibilities. So to that extent, there is you know, some attempt being made to figure out to what extent it is implemented is yet to be seen. So there was some reports saying that even in this case, there might be some issue in figuring out. But you know, one safeguard is the moment you try and convert it into fiat currency and then you're paying 30%. So eventually there is a trail which could get to, you know, the tax department gets to know. So that is one aspect, you know, which is being looked at from trying to figure out the source part of it from a taxation perspective.
Right. So could I, if I was sitting in Singapore dealing with someone in India and they were paying me, I would be selling to them. Is there a withholding tax on that? Right.
So here it will be under the general provisions in which you make a withholding to payment to a non-resident. But the rate under the domestic law will be 30%. Of course, you can check out the treaty and see if any treaty benefit can be availed. But otherwise, a withholding tax obligation is also there. Also, there is in the news that you know, we also have an equalization levy. So if it's an exchange in Singapore, which is meeting the parameters of an e-commerce operator, so would a transaction happening at the exchange require the exchange to deduct an equalization levy on it, or make a deduction to the payments made to the resident Indians? So these are you know, few points which the department is working on taking inputs from, but it appears that you know, the equalization levy provisions could be applicable in certain cases on the foreign exchanges as well.
And I presume the treaty let out would be no PE, no tax.
Yeah. Broadly the same.
Yeah, okay, but sounds very messy. And I presume, Tim, nothing as exotic as that in Australia, based on what you were saying a minute ago.
No, look, in Australia, obviously we tax on a worldwide basis, so source is sort of less of an issue. Where the ATO is having some effect here is via one of its other government agencies, AUSTRAC. So AUSTRAC is a payment reporting organisation that has an obligation to report all currency movements greater than 10,000 Australian dollars. So each of the crypto exchanges in Australia are becoming subject to AUSTRAC regulation. And so, as Risha mentioned, if you can't get each of the digital asset exchange transactions, they will pick up the fiat transaction paid back to the individuals. And so there is a mechanism that way to identify these transactions.
Oh, okay. Sounds very sneaky. Sounds like they're going to be tied up in a lot of red tape. though, tracking all of this stuff down.
So every financial institution in Australia is already subject to it. So it's really just an extension of an
Just
existing
another-
regime.
Right. Yeah. Yeah. Just another one of those. And William, no withholding tax in Singapore, in Hong Kong anyway. So you don't really worry about that stuff, but you do worry about source, don't you?
Which you thought, I mean, if you, I think again, digital asset, we have no rules on it yet, but back to basic. If you trade your security in an overseas exchange, then it's sort of outside Hong Kong. So if you trade, I think the same could be applied to cryptos. If you trade your crypto in Japan exchange, Bermuda exchange, Liechtenstein exchange, then you will be exempt from tax because there's no sourcing in Hong Kong, because we can treat it as a listed security. But if you sell to someone else that you don't know, I think there's a presumption, because you are sitting in Hong Kong doing the trading, there's a presumption that the other side of the contract is also in Hong Kong. If you cannot prove, that's the danger of it. Of course, you can argue that I can never tell where these numbers come from. I mean, just a bunch of digits that I'm selling to that I can never tell where they're from. So, but because the onus of proof always on the taxpayer. So if you can prove it, then you are in danger of losing it.
And so this, I've seen this most in the context of GST, where I think someone in the audience will correct me if I'm wrong, that if you are transacting through SGX, there is a presumption that the counterparties here, in which case it might be an exempt financial service. If they're overseas, if you're doing it on an overseas exchange, presumption it's zero rated. Where we are sort of getting glimpses of it on the income tax side is in relation to DeFi transactions. So lending out cryptos and getting a return, as I think we discussed the other day, who are we lending to and what is the source of that return? Because it's very important from a Singapore perspective and a Hong Kong perspective. I presume, from Australian and Indian perspective, if you're being taxed on a worldwide basis, income is income as far as the interest is concerned. But for Singapore and Hong Kong, it can make a difference, particularly for individuals who in Singapore don't get taxed on foreign sourced income. So it'll be interesting to see if the income tax follows where we've sort of got to with GST. Richa, you were going to say something about GST, or that you didn't want to talk about it or something like that?
No. So GST, again, the current thought around that is that it would fall into a virtual digital asset would fall into the category of goods, because the definition of goods under the GST Act in India is very wide, a movable good. Now, any transfer in title of that would constitute supply. So there would be a GST of 18%. Now, again, because there is no guidance on that, there is another school of thought which says that this is something like a transfer of a rendering of services. So there is a difference of view here, but most people consider this to be a transfer of a good. Now, coming on to the official guidance, what we get to hear is that the GST Council of India, it is examining in detail. There have been committees put in place to examine the entire crypto ecosystem, the various intermediaries, the income streams that they have, and then come up with a consultation paper to show whether it can be classified as goods or services, and whether it should be on the gross or the net value, how it happens in the case of exchange, and how the reportings and all should be fitted in. So currently, basis the existing laws, most cases it is being considered as good. And as you mentioned, if it is something coming to India from outside India, obviously in that case, if it's a good, then there is no taxability under a reverse charge. So that bit is there, but again, the GST law is still evolving.
Okay, I'm just curious as to how you export Bitcoin if you don't know where it's going or where the receiving wallet actually is. But anyway, let's mark that as a point for discussion in due course. There was something else that we mentioned. One of the things you can do with digital tokens is reward your employees with them. Tim, I think you indicated that might be a big area in Australia.
It is. One of the challenges, I suppose, first before determining whether we're rewarding employees is who is the employer. So in various scenarios that we've encountered here, where you have a DAO as the payer of the core contributors, the question is the DAO an entity which is capable of employment? In other scenarios, we have a labs entity, where the labs entity is the entity engaging with the core contributors. There is very much a consideration around whether those contributors are employees of the labs entity or whether they are independent contractors who are contributing to the project. In either case, where we get to is if they are employees, then there is a question mark around whether the payment of those employees through tokens is subject to PAYG, or is it subject to our FBT system on the basis that these tokens are effectively property rights. So if they're not currency, then are they the provision of currency rights to FBT? And if so, are there any concessions under the FBT system? And why is that important? Well, it's important in that PAYG is a withholding from wages on behalf of the employee, whereas FBT is imposed on the employer in Australia. So it may be taxed to the DAO or the labs entity itself.
So you're saying if there's nothing to deduct because you don't have a cost, the company effectively gets taxed as if it received income.
Yeah, that is potentially the outcome.
Yeah, that's pretty nasty. And of course, PAYG, there's nothing to deduct tax from because you're not paying them cash, are you? You're just giving them. So what do? You take half a dozen tokens and stick them in the ATO's wallet.
Well, the ATO prefer to receive cash, so you might pay them half the tokens now and monetize half on exchange to pay the PAYG.
Pay the rest, yeah. Okay, that sounds very messy. And of course, there are rules around, as you said, if you're an employee or a contractor, as to when you pay the tax. Because I understand that if you're an employee and there are certain restrictions over your ability to sell the things, then the tax point gets pushed out to when you can monetize the assets and turn them into cash and pay your tax bill.
Not necessarily, David. It probably depends on the characterization of the tokens themselves.
Well, yeah, I mean, are they shares?
If they're shares and securities, then they may fall within our employee share scheme provisions. If they're not security tokens and they're utility tokens or payment tokens, they may not fall within our employee share scheme provisions, and the employee might be subject to tax based on the market value when they're granted.
Yes, which is the fundamental case law, isn't it? If you take the legislation away, potentially you're taxed on the value of the option when it's granted to you at the beginning, which could be a bad outcome.
Could be a bad outcome. Could be a good outcome depending on what the value was when you received them.
Well, that's true. So you get taxed at a very low income tax value, but you sit on them for more than your 12 months and you're into long-term gains and stuff like that, which is the same as the way it works in Singapore, which is if you get taxed up front, then the rest is tax-free, essentially. So that's quite a nice outcome. So we have this split between people wanting to be taxed up front now and then people who say, no, I need to wait because I don't have any cash, etc., etc. What about Hong Kong?
The same. If you are given a vote, then you are, if there's no option to say vote, so you give them crypto, you give Bitcoin today as a payment for service, then you get taxed. Well, I mean, that's the value. You get taxed at today's value. So, and then afterwards, you sell it like sit on it for a number of years and sell it as your capital gain as personal investment. Provided you're a trader in cryptos, then you'll get taxed at all. But again, like if you just receive the crypto for today, you need to think about whether you want to receive crypto because you're taxed at X amount of value, but 2 days later you have lost half the value already. So
well, yeah. And this is the other issue with the volatility of these tokens, which is that if you do get taxed up front and they go to nothing, there's no mechanism for clawing back the tax that has already been paid. So that can cause a lot of heartache as well.
I think there's some options that we have. If you want to, like, you can choose to tax upfront and you don't have to worry about it. But if you lost money, if it's like and then there's no avenue for you to claim it back, say overpay tax. So that's your choice you make, irreversible.
Yeah, nothing you can do about it. Okay, so there's obviously, so if anyone's thinking of setting up a digital token remuneration scheme for their employees or people who they think are their employees, come and talk to us first, because there's a lot to think about. The other thing that we've stumbled across in our discussions with clients, not that they've come to us asking those questions, it's just the conception they have in their minds that although they've got people all over the place, so you might have somebody programming in Lithuania, some doing sales and marketing in Australia, the brains might be in Bali, and they think by sticking a box in Singapore, that solves all the problems. It's not so simple, is it, Richa? Do you think?
Yes, absolutely, David. The tax laws, the international tax laws, as we know them today, they were written in a different era altogether. At that time, there was a concept of certain degree of permanence of residence of an employee or an entrepreneur, a place of place of management sort of concepts. So which kind of go haywire in a system that we are visualizing today. So yes, there are indeed gaps which need to be plugged, and thought has to be given on a global level on this one. As far as India is concerned, some bit of attempt was made as far as the global nomads would be considered. So far our taxation is on the period of stay, which is 182 days, where you become a resident and your global income gets taxed. So in some cases, what they've now put down is there's a linkage with the citizenship, which they've tried to establish. So if an Indian citizen who is not a resident because of a domicile or residence in any other country, and he has India source income exceeding 1.5 million INR. So in that case, he will be considered a resident, but not ordinary resident in India. So to that extent, the India sourced income or income from a business controlled from India gets taxed. But that again does not really capture the entire income that may be there on a global basis. So this was one small attempt which was done. But yet there is definitely a need to look at how this has to be taxed.
Yeah, and Tim, presumably that's the same in Australia. And going back to your question of an employee is one thing. If they're employees, you as an employer, you may have some Australian reporting obligations and withholding obligations. You may also be creating a permanent establishment for the entity that you're working for. So there's a whole can of worms opens up with these things. Are you seeing lots of issues with that?
Yeah, absolutely. And probably coming back to your original question, David, Australia still has quite an onerous controlled foreign companies regime. So yeah, it's not possible for the project originator sitting in Bali to incorporate a company in Hong Kong if they're still Australian resident. Australia will look to tax on an attribution basis.
Sure.
Any controlled foreign companies' income back in Australia that's not active under some very old world definitions.
Yeah, and so maybe that's one of the areas that is going to need to be significantly looked at, because it isn't just cryptos, it's everyone now. Everyone working from home, working from wherever they want to, sitting on the beach in Sri Lanka, working away, talking to their clients in London, etc., etc. Strikes me that without getting into a complete mess of red tape and reporting, something's going to have to be done to simplify this and carve it up in a different way. But we're sort of running slightly towards the end of time, but I do have one burning question that I was wanting to put to you, and this is to put you on the spot, which is that given where you are with cryptos, with legislation, attitudes, etc., etc., would you recommend anyone wanting to do crypto stuff to set up in your country? If so, why? And if not, why not? So maybe, William, maybe you can lead the charge on that one. Hong Kong, nice and clean, straightforward.
Yeah, we still have a really nice fund regime and fund environment here, like PE fund, whatever fund you want to set up, trust fund. We still have like the ecosystems here in Hong Kong. And I just like look at one that's just been set up last week, dealing with digital asset, a fund that came in fund doing digital asset. We still can go to the source principle and try to get away being taxed in Hong Kong. But even though you want to be taxed in Hong Kong without the fund exemption regime, Hong Kong's only 16.5% tax. And it's very good. If you pay tax in Hong Kong, you might get away with not paying tax anywhere. Go to talk to Singapore authority. We pay tax in Hong Kong. We don't need to pay tax
Sure.
in Singapore.
Well, yeah, unless you,
we don't have GST, man. We don't have GST in Hong Kong.
no, that's true, no GST, so that makes it easier. But unless, of course, you've got a distributed workforce all over the world, in which case it doesn't actually make any difference, does it?
Yeah, that is the problem that we have. I looked at one last year, and like you say, David, they have a program Lithuania. They have a guy sitting in New Zealand, and some guy sitting in Taiwan, some guy sitting in Hong Kong, some guy sitting in Russia. Where you tax them is it taxable in where they just the guy is sitting? So it's a great question everywhere. There's so many countries that it's difficult to deal with.
Yeah, sure. And Tim, I presume, what are you? You're sitting on the fence? Are you promoting Australia?
It's an interesting question. So the government here has very much said that they want to provide a lot of certainty to crypto projects in Australia. But hearing everybody on this call, they're a long way behind providing any certainty. So if they were to provide the certainty that I think they want to provide, then it might actually be a really good jurisdiction. Until then, it's probably not the best jurisdiction. Although what we are seeing a lot of established here are crypto miners. So we do have a lot of space. We do have a lot of renewable power.
Got a lot of space, yes, certainly.
So crypto miners are very much finding a home here.
Send them to Coober Pedy, and they can mine underground somewhere.
Not so much solar underground, David.
Sorry, no, solar is a bit scarce.
people are getting out of Hong Kong crypto mining because the electricity bill is so extortionate.
The
So it's
electricity,
not,
yeah. Well, maybe when they all move to proof of stake, it'll get a lot cheaper. But I'm saving the best one to last. Richard, you've got to dig yourself out of this legislative hole and see if there's any light at the end of the tunnel.
So, David, what I would say is that, yeah, we boast of volumes. There is a big affluent young population which is willing to invest in anything new in terms of crypto, any new asset type that comes in. There is a lot of trained manpower because India is invested in STEM a lot, STEM education. Again, if we were to look at the technology side, again, we've been in the front runners. So these are the positive factors that you need to take into account. Now coming on to regulation. Regulation is evolving. This is something, one will have to take care of, to take note of, to watch it. And the taxation laws, again, it is just at a very nascent stage. It has to evolve. Representations are being made to the government. And in the past, we've seen that these are considered and clarifications and all that are issued. So the cost of doing business will have to take into account the taxation and the regulatory aspect. Is all I can say at this point of time.
But certainly there's a lot of crypto support coming out of India, right? There's a lot of very savvy, well-educated people that are involved in that area. But also there's much more to blockchain, obviously, than crypto. The crypto is just the froth on the top.
Sure.
And Singapore sort of gets that. It knows that it wants to attract the people that are going to work in the blockchain environment, and let's keep control of what's happening, on the top of the beer, sort of thing, so it doesn't overflow. But good. Well, thank you for that. I have to inform you it's not yet over because we have a few questions here which I haven't had the chance to look at. But if people have done their homework properly, they'll have upvoted some of them, but no, we've only got a one hands up for that, one for that. Sorry, we've got a 3. Right, let's start with the 3. Where is it? Oh, I probably created a rod for my own back here because I'll probably have to answer it. Given the IRS circular generally categorizing payment tokens as for trading purposes, do investments in, say, Bitcoin are directly treated as trading income, or based on the infrequency of transactions, it can still be categorized as capital assets? Yeah, okay, well, I think I get the answer to that. I think I mentioned in the presentation that although the IRS categorize the different types of crypto differently, they can all be used largely for the same purpose. You can trade them, or you can buy them and hold them, and then they do whatever they're supposed to do. So if I buy Bitcoin, which produces no other income, that's not a great start under the badges of trade. However, if I do nothing other than sit on it for an indeterminate period of time, I've got no thoughts of buying it to make a quick buck, etc., then very much so Bitcoin can still be treated as a capital asset for certainly Singapore tax purposes. But make sure, as I mentioned, your accounting treatment doesn't put it in inventory, because then you are dead on the spot. Thoughts around that, Tim? Same in Australia, although you've got your capital gains rules, haven't you?
We do. But certainly if you were to have held Bitcoin for a period of time, not traded it, then you could certainly get capital treatment.
Right, okay.
Now, say Hong Kong, if you, it's just a commodity. I mean, although it's no legislation or digital asset, but it's treated as commodity. So if you sit on it and not trade it, regularly, better to trade. If you fulfill those arguable, is capital, you don't get tax at all.
Yeah. No, I think the trick is to not be distracted by what the revenue have said, which is we're going to categorize these down to determine how they should be treated. Actually, it's what you use them for is the critical question. Staking from an anonymous attendee. Oh, and this has got a two vote. Oh, it's gone back down to one. Hang on. No, two. Staking a digital asset can yield a return. Yeah. However, the return may not be interest as we commonly understand being for the use of money. How then do we look at such returns from staking and the source, foreign or Singapore? Very good question. Again, that's a slightly Singapore one, so I'll start off with that. But yeah, is it interest? Very, very good question, which is typically for the time use of money. What if it's some sort of profit share or some sort of other measure? Is it interest? Secondly, the one we didn't talk about was whether the person at the other end who is paying you this return treats it as interest and decides that they're going to withhold tax on it, which their jurisdiction might demand. And thirdly, the question that we did talk about, in order to determine the source of that income, you've got to know who you gave the money to, and that is a problem in the crypto world, trying to identify who that counterparty is. But if we follow the GST example and we go, well, if it's done through an organization outside of Singapore, the returns are foreign sourced. If it's done in Singapore, something like that. Guys, any other thoughts around that?
One tricky question that I have, I'm not an answer to this question. But in Hong Kong, we do have like provisional credit. If you put it outside Hong Kong, then your interest is not taxable in Hong Kong. But you said if you try to lend some money, I'll say you would know who the identity of the other guy, so you can prove that whether it's like outside Hong Kong or not. But one tricky thing, if you lend someone in crypto, you have to change the title, the ownership of the crypto. So is it the sale of crypto that you get your return? You 1.001 crypto back is a sale.
Yeah, like a repo transaction sort of thing. Yeah.
So that's interesting. No law on that.
Yeah. Well, these are things that are going to have to be answered. Let me see if I can find. An easy one here. You mentioned cryptos are excluded from the tax incentive schemes. I presume you mean the various fund exemptions, 13D OU. Is it the same for the locally administered trust, foreign trust regime? It is almost certainly the case. Oh, Grant Thornton would like to answer that live, it says here.
I think you clicked on it, David. So that's why you are.
Oh, who clicked on it? Did you click on it? No?
No, you clicked on it. So might be you answer live.
Oh, right. Here's one from the audience to someone else who may be in the audience. So that's an unusual one. Indonesia recently implemented legislation to specifically tax trading of digital assets, e.g. Bitcoin, Ethereum, etc. The regime will subject digital assets to standard rate of VAT and capital gains tax at 0.1%. Do you expect other countries within ASEAN, APAC region to take note on its success and follow that course of action? Oh, okay. Right, well, I will sidestep that one because it isn't an Indonesian question, but you guys, any thoughts on, because you've already sort of got it in India, haven't you, Richa, with your withholding tax?
Yeah, so I think for us, the regime has been put in place. We have to just see now how it is evolved. I think the rates are much higher. The regulatory bit is what we are now waiting for. You know, a lot of things on things like the ICO, whether it can be a security, is it an investment pooling? So a lot to come from the regulatory side. Even when we talk about remuneration, currently it doesn't really fit into our ESOP sort of remuneration regime. So there could be dead losses to employees if they sell them later. So I think on the trading bit, the capital gains is in place, but yeah, a lot to come from the regulatory side.
And these are final taxes, so you can't claim anything back, right? Once you've paid it, that's it.
Yeah, yeah. The withholding tax, obviously you take a
Withholding,
credit from
yeah.
your overall tax liability, but in effect you get taxed at 30% for your you know, a transfer of a digital asset.
There's not going to be much left over after a 30% tax credit. I don't know anywhere. I mean, even Australia, what are you, 30% corporate tax? Oh. Right. It seems, here's another question. This got a 2 thumbs up. It seems to me that the tax authorities' interest in the taxation or non-taxation of cryptos was largely triggered by the surges in the asset prices during 2019 through to mid-21. Given the recent downtrend in asset prices since 2022, do you think the tax authorities' interest in making digital assets taxable will change? If not, there may be lots of companies seeking to utilize and carry forward losses. That was exactly the point that you made, Tim, wasn't it? Which is that, you know, it's great being taxed as trading when there's loads of profits to be made. What happens when the boot's on the other foot?
That's right. And I think it's going to be an area of attention for tax authorities globally as more and more people choose to invest, whether the market goes up or down. They see it as an area of leakage.
Yeah, it is interesting though, isn't it? That and you see it's the same in Singapore. Every gain is taxable, every loss is capital. Right, and presumably that's the same approach in Australia. They'll tax you for trading, but if you go and volunteer that you're trading and you made a massive loss, they'll say, "Oh no."
It's a starting assumption.
Yeah. Indeed. Right. Okay. Well, I would suggest talking to our esteemed leader, Nat, that we have come to the end of our session, and there are some other questions. There's a number of interesting questions in there that we don't have the time to look at, but what we can do is take a look through them. To the extent people might have left any traces of who they are, we are quite happy to drop them a note and try and answer those questions. But I think on that note, I would like to thank everyone, and including Chetan, who's hiding in the wings for his presentation. And thank you guys for giving us some very fruitful food for thought. There's obviously a lot to talk about. There's a lot of common issues between the countries, and hopefully it will all be good going forward for people that are wanting to be involved in this exciting area. So thanks again for your attention, everybody, and get well soon, Tim, from your COVID.